Good morning and good afternoon, depending on where you're listening to us from. My name is Larissa Green with Advanta IRA, and today we are excited to welcome John Schaub, who is going to be talking about change and also previewing his upcoming class with Peter Fortunato. So we'll have John on in just a second. I just wanted to share a little bit of information with you on Advanta IRA before we get started. I won't talk for long. I know everybody's very anxious to hear John and also ask him some questions. So again, my name is Larissa Green. I've been with Advanta IRA since 2011. I do education and business development for the company, and I have really been in this role for probably about 8 years now. Prior to this, I did a variety of things for the office, including open new accounts, transactions, transfers, paying bills on behalf of clients' accounts, as well as receiving any income for those accounts as well. So I'm very familiar with the self-directed process. My contact information is here for you in case you have questions. I do want to let everybody know that although often we talk about the rules for making investments within an IRA and different strategies and structures we see, we actually do not provide any investment, legal, or tax advice for you. So if you do have those questions, let me know and I can definitely refer you to professionals that can help you with those. Just a little bit about Advanta IRA. We have been in business for almost 20 years and we handle qualified funds. We don't sell any investments at all. We simply hold the account for you per IRS rules so that you can make those investments that you see fit for your retirement account. So we like to say invest in what you know best, and you can do that best with a self-directed IRA or 401k. So we hold the account, you find the investment and put your money to work. We have two offices. We're here in the Tampa Bay area of Florida, which is where I'm located. And then we also have an office in Atlanta, Georgia, but we can help clients nationwide and even worldwide. So if you have a US based retirement account, you can invest into things like real estate and private mortgages. And really, that is what a self directed IRA is. It gives you the freedom to go out there and find those investments that you want to make with a retirement account that are outside of the market. And so Morgan Stanley, Charles Schwab, Fidelity, those are all great companies, but what they do is much different than what we do. So they hold your accounts and help you make investments into market-based assets. And what we do is really just fill the gap in the industry where we hold the account and help you make those investments that you choose that are outside of the market. So again, real estate, buying and holding single family residences, duplexes, triplexes, multifamily. It could really be real estate in so many different forms. It can also be in the form of a note and mortgage, so lending money from your IRA. In that case, you get to be the bank with your self-directed IRA. And we have webinars on a weekly basis, and we're always talking about these different asset classes and how they work within an IRA. So I would encourage you to join us for one of those. You can also check those recorded webinars out on our YouTube channel. Just go to YouTube, search Advanta IRA, and you'll find all of those there so that you can learn more about self-directing your account. I just want to very quickly touch base on the different types of accounts that can be self-directed. For whatever reason, a lot of times people tend to think that if you don't have a Roth IRA, you can't invest in real estate. And I'm really not too sure where that comes from, but the good news is if it ends in IRA, it can be self-directed. There are also employers plans or employer-based retirement plans up here that you can self-direct, simple IRAs and SEP IRAs, as well as solo 401ks. So if you're self-employed, you have self-employment income, even if you have a W-2 job, you can still have a solo 401k, and those are great accounts. We do webinars on those. I just did one about a week and a half ago with my partner, Alex. If you guys want to learn more about that, again, check out YouTube. We also can help you self-direct health savings accounts and education savings accounts. So those are the two sort of outside of retirement, but great accounts, great ways to save and also invest in what you know. We have been doing a series of networking events, and so of course this has sort of grown out of the fact that we can't have lunch and learns at our office. So those of you that have attended some of our seminars, you know that we buy lunch and we teach on self-directed IRAs. We have guests speak for us. As a matter of fact, John has joined us for lunch and learns in the past. And, you know, of course we can't do that right now. And so what we're doing now instead is Zoom calls every other Friday. Everybody is welcome to join us, and they have been very successful. We've had 60 to 100 people on. Everybody will have the opportunity to introduce themselves and talk about, haves and wants, letting us know what investments they're looking for, what they have to sell or trade. And so it's been a lot of fun. I would really encourage everybody to join us. Our next one is, as a matter of fact, this Friday. It's at noon Eastern Daylight Time. So you just go to our website, advantaira.com/events. You'll find it listed there. Go ahead and register for it. You'll receive the link to join the call. And it's been a lot of fun. And we open the floor up to discussion and questions for the attendees. And again, every other Friday. So with that, I want to bring on John. How are you doing today, John?
I'm doing just well.
Thank you so much for joining us. And I'm going to move this over. So I did include the website for John is johnschaub.com in case you were unsure. I'm going to turn it over now to John, and he's going to talk a little bit about his class and answer questions for you. Thanks, John.
Thank you, Larissa, and thanks all the folks at Advanta that do such a good job. This is not going to be a talk about retirement accounts, but I want you to know that probably a third of our assets are in retirement accounts, and then they're all real estate and mortgages. So we see them as a wonderful way to both protect assets and protect the income and take the income out when you need it. So that's a topic for a different day, but I encourage you to learn as much as you can about retirement accounts, regardless of how much you make or who you are, because the mistake most people make, I think, is that they don't think they have enough money to start a retirement account. It won't grow very large, but that's faulty thinking. Even if you start with a very small amount of money, a few $1,000s, over time, that money could grow into a significant amount, and then you can take it out tax-free or take it out at a better tax rate, depending on what kind of account you have. Peter Fortunato and I have been friends for going back to 1973. So I don't even know how many years that's been, but it's we're pushing our 50th year anniversary, I think. So we have had a lot of experience with recessions, with tax law changes, with different political parties in charge, and we have learned over the years that change is going to continue to happen, obviously. And when it happens, there's always opportunity, because a lot of people do not prepare for change. They think it's not going to happen this time. You hear that all the time. They say, well, it's going to be different this time, Well, it's rarely different this time. We have these large business cycles, and those of you who are my newsletter readers, and I've been writing a newsletter since the 70s, probably read my letter earlier this year in January. I wrote a letter that talked about change and about changes coming. And this is before we knew about COVID coming. The COVID event is really impacted the current economy in an interesting way. The federal government has put trillions of dollars into the economy, and because of that, the economy is kind of, I think, artificially rolling along. But we still have some unemployment, and I anticipate probably a business cycle here. It's been 12 years since we had the last business cycle, and that's a long time. Fortunately, if you're from the South, places like Florida and the West Coast of Florida especially, we've seen quite an inflow of new residents, because people who live in the big cities up north, and I know at least 4 people who've moved them to my town from New York City, and that's just folks I know. So I know there's a lot of people moving into our area from up north, and when they come, they are not real price sensitive. They're more interested in a safe place to live and a good climate. And because of technology, talking about changes, technology has changed a lot of things, and the ability to work from home. And all my kids, not all of them, but they all have worked from home, and many of you have probably been working from home for the last 6 or 7 months. And the folks coming down from New York, they kept the same jobs. They haven't changed jobs. They're just working from Florida now. So things have changed, and things will continue to change. The real estate market, once you understand your market, it's easier to kind of keep track of what's going on. And the more you know about your market, one reason I stay in a single family market is it's fairly easy to understand what's going on. We're very fortunate that we don't have a bunch of commercial properties or office buildings right now. And over the years, we've owned all different kinds of properties, but about 35, 40 years ago, we decided to go strictly single family. And so we converted everything into single family residence. I don't own any duplexes. I don't own any condos. I own only houses, and I own only houses here in my town. And I have owned property in 10 different states. So we've done a lot of consolidation to get everything back to Sarasota. But I think I live in a good real estate town, and there's some risk in that strategy, of course. I mean, my town could go underwater, or a hurricane could do a lot of damage here. But you know, we've been here in business for a long time, and we're willing to take that risk because we have a pretty good feel for our market and for our topography, and we know where to buy and kind of what to buy. So when Peter and I teach this class, the 10th and 11th of October, we're going to talk about change that has happened and that changes that we anticipate over the next 10 or 15 years. And a lot of it is personal. You get wiser, hopefully, as you get older, but you get older either way. And as you get older, you start thinking differently about how to what type of properties to own, and how to manage them, and how much work you want to do, and how much cash flow you want, where the cash flow should come from. So those are the type of things we're going to be talking about. How to acquire the right assets, how to protect those assets, how to get the cash flow you need when you need it. You can see, if you get on our website, you can see a whole list of bullet points of things we'll cover. So let's go to the next slide. Let's see if I can make the next slide pop up. Nope, I can't see it anymore. Larissa, you'll have to make the next slide pop up here.
I got it. And then also, I wanted to mention, because I did not mention it before, if you have questions, just make sure you type them into the chat box, and John will be taking questions throughout the webinar. So if you have a question, just get it typed in there for me to read out. I don't look for raised hands, so please don't raise your hand. Just go ahead and make sure you type the question into the chat box, and I will see it that way. Thanks, John.
Thank you. Thank you. Larissa's put up a slide that shows the book I wrote. I wrote it. I've written a number of books. This book was originally published in 2005, and this is the second edition. It was published in 2016, I think. And it's a very good book for people getting into this business. So I would strongly encourage you to read the book. It's a great way to get started if you're fairly new to the business, and if you've never come to one of our classes. I won't say it's mandatory, but you'll get a lot more out of the class if you read this book first. We don't sell them from our office, but you can get it on Amazon. Get the best price you can. So that's enough said. But it's kind of an all-inclusive book about how the strategies we use to acquire properties, and why we buy houses instead of other types of properties, and how we finance them, and how we manage them. So it'll teach you a lot. Next slide, please.
Okay, great. And also, we had a question on your newsletter. How do they sign up for the newsletter, John?
Everything that we do online anymore. So we don't have any walk-in business. So you go to my website, which is johnschaub.com. Just my name, JOHNSCHAUB, johnschaub.com.
Great, thanks.
Okay. So the next one just talks about that we've been doing this a long time. I only teach, even in a good year, I generally teach 2 classes a year. So we're not full-time teachers. Peter and I both really like to teach, and you'll see that if you come to our classes. I mean, we more than really like it. We love teaching. We love helping people learn about this business, and we like watching them light up as they learn new ideas and go out and use those new ideas to make money. So if you come to the classes, you will meet a lot of folks who have been to our classes before. We get a lot of repeat attendees, but we only teach a couple times a year. So if you can come in October, please come. You have to register ahead of time. We're kind of limited on space because of COVID, so we're not going to accept any walk-in traffic. Next page, please. Okay, 6 steps to target. Let's go to the next slide and see. We'll have a list of these steps. Couple things to think about here. We're not going to spend a lot of time today on this, but the benefits that you want is something to focus on. Do you want cash flow? Do you need growth? When do you need it? And that should drive the type of property you buy and how you finance that property. If you're buying for retirement, something you're going to want cash flow from 10 or 15 years from now, you can finance that in a different way than if you need cash flow today. If somebody needs to buy property because they are trying to get out of a job and they're trying to maybe create a $5,000 or $10,000 a month income today, then they need to use a strategy that produces cash flow now. And that generally involves owning properties with other people or borrowing money from sellers and arranging financing on property that produces cash flow. And we'll go into some detail on that in the class. The price range is important. I focus only on certain neighborhoods and certain price ranges in my town. The people who don't tend to buy things don't have enough focus. You know, you can't, if you just go to a realtor and say, show me a good deal, they're going to show you all their listings. And I don't care if you say we just want to buy a house, they'll show you their duplexes and their apartment buildings and everything else, condos and everything else they have, because they're trying to sell you something. You should have a very specific target, the price range, the area you want to buy in. And I own properties in about 7 neighborhoods, and I like all those neighborhoods, and I'll buy more property in those neighborhoods, but I don't go outside my area. Okay, next slide, please. So neighborhoods and then sellers. You know, I'm not going to buy from somebody who is not willing to sell either at a good price or on good terms. I don't go to the banks to borrow money to buy real estate. I've never borrowed money from a bank to buy a house, and I never will. So I'm looking for a seller typically who has a profit. I want a seller who owns a piece of property that I want, of course. So the right neighborhood, the right price range, the right construction. I like to buy houses that are in very good condition. I don't want to buy a house that I have to spend $30,000 or $40,000 rehabbing before I can rent it, because that just increases my cash investment. So I'm trying to buy with as little down. You know, one of my students wrote a book called Nothing Down years ago, and it's still worth reading. But when you buy something with nothing down, you have to be pretty careful about the cash flow. You have to make sure that you can afford to hold on to the property. But using high leverage, so you're looking for sellers who will finance for you with a small down payment, who own a property in an area that you want, that's well built. And if the terms are good, the price is not important to me. And when I say that, I'm not going to pay way too much, but you know, I'll pay a retail price if the terms are great. Because when I look back at the houses that I've owned for years and years and years, most of them have doubled in value 4 or 5 times. Well, if I pay $50,000 or $55,000 for a house, it doesn't make a whole bunch of difference if it's going to double in value 4 or 5 times. But what is very important is that I can afford to hold it until it doubles a couple times. So my strategy is to buy things that will double several times over time, and the bulk of our profit comes because both rents and values go up over time. Next slide, please.
Okay. And I also had some questions for you. We have somebody asking about your out-of-state property. So when you owned out-of-state, were they single-family homes, and how did you manage those tenants?
That's a good question. Yeah, actually, my friend Peter Fortunato and I owned a house together in a town, Danvers, Massachusetts, up close to where he used to live. And our deal was that Peter would manage the property. So to answer your question is, I always had somebody who lived in that town manage the property. I learned a long time ago that managing from far, far away just doesn't work. You know, when you call a plumber and you're 1,000 miles away, or you try to find your tenant and you're 1,000 miles away, that's not going to work very well. So you have to have somebody locally to do it. And you can try to hire a realtor or a property manager, but my experience with property managers is that they try to put a tenant in as fast as they can so they can get paid a commission. And sometimes they try to put a tenant in there who will pay the most rent, and that can be the wrong tenant. You know, you can get a lot more rent from 6 college kids than you can a family of 4. I'd rather have a family of 4, because when I get my house back, it'll be in a lot better shape. So to answer your question, we had people in those towns manage those properties. The typical deal would be that I would put up the money to buy the house, they would manage it, and then we would split the profits 50-50 going out. Now that worked fairly well, but what I found was I made more money in my town for 2 reasons. Number one, when I sold, I got 100% of the profits, not 50%, and managing the properties was not a problem for me when they were in my town. I'm a really good manager. My goal is to be the best manager in my town. My goal is to have the best tenants in my town. And I measure that by how long the tenants stay and how much maintenance we have on these houses and how our rents are compared to market rents. So how then put all that together is how much cash flow you end up with a property. But and my average tenant stays a long time. It's probably 8, 9 years right now. I've got people who've been with me 30 years. I guess my average up. If somebody only stays a year or two, I consider that a not successful adventure. I'm looking for somebody to stay longer. So I ask questions. One of the first questions I ask people on my application is, how long do you plan on staying? And if they say a couple months, that's the wrong answer. I had one lady who was still with me. She'd been with me 20 years, and she said, the rest of my life. Well, that's the right answer. So if you want to rent a house from me, remember that. Put down the rest of my life.
Thank you for that, John. And sort of going along those same lines, and I do think you really are sort of in a roundabout way already answered it, but what about advice for somebody who owns property close to home but is planning on possibly moving out of state?
Well, if you don't do it, if I wanted, my daughter lives in Australia, so if I decided to move to Australia, I doubt I would just sell all my property here in Sarasota. I would hire somebody to manage it, but I wouldn't hire a commissioned salesperson. I would hire somebody who already was already owned property themselves, who was an investor who already managed their own property, so they had some hands-on experience, and I'd check them out, make sure the properties look good, and I want to see some finances. I want to see where they collecting rent on time and what the rents look like, and then I would make them a deal to share some profits with them. There's two different ways I've done it over the years. Here in town, I have some properties leased to other investors over long term, so they do all the work. It's a net lease, so they pay all the expenses, and I just get a check each month. But I get 50% of the profits. I have a guaranteed return plus 50% of the upside profit, plus my rent goes up every once in a while. Or the other way to do it would be just to have somebody buy in. There's a lot of folks out there who would like to buy property, and if you already own, let's say you own 4 or 5 really good houses, it'd be a shame that are rented to good people. It'd be a shame to get rid of those tenants, and be a shame to sell those houses. So that'd be an excellent package to sell some to another investor who would put some money up, but leave maybe half interest for you, or you own half the property and get half the profit as time goes up. Or that's negotiable. You could keep 75% of it or 80%, depends on how much money they put into the deal and what the price is.
Perfect. Thanks, John.
Number 6 here says make an offer. The reason most people don't buy more property is they don't make many offers. If you come to class and meet my friend Peter Fortunato, and many of you know Peter, you will find a man who's made more offers than any other person on earth today. He makes offers every day. I mean, that's not an exaggeration. Peter goes to meetings and makes offers every day. He loves to make offers, and he buys a lot of property or puts together a lot of really good transactions for both himself and for other people because of that. Well, I'm not suggesting that you make offers every day, but if you're new at this, you have to have a budget to say, I'm going to make an offer at least once a month and maybe once a week to get started. And that doesn't mean you're going to buy something once a month or once a week, but it means you're going to make an offer to somebody, a written offer, which means you found a property that you think has some potential, and you learn a lot when you make that offer. You learn a lot about how the other people react. You learn a lot about the market. You learn how you react. You get. I can still remember the first offer I ever made. My hand was shaking when I was filling out that contract. Now, I was filling it out in front of somebody who I was trying to buy from, and that's maybe not the best thing to do when you're first getting started, because that's pretty exciting time. But you should sit down, in the peacefulness of your own house and write down an offer that you're willing to make to somebody in some detail. How much down, how much monthly payments, all that, and then go present it and see what kind of reaction you'll get. The people that typically never buy using owner financing never buy because they don't make that offer. They just make an offer where they're going to go to the bank and borrow the money. And borrowing money from the bank is not a bad idea today because rates are so cheap. But you'll find that if you start doing that, if you get in that habit, that a couple of things happen. Number one, it slows down your deals, so you really don't make the best deals. And number two, at some point, the bank's going to cut you off. And it may not be as you have, it may just be the business cycle. If you're new to this, you may not realize this, but there's times in the business cycle where banks will not lend money to investors. So if you're an investor and you find a really good deal, and the only way you know how to buy is to go to the bank and borrow money, and they won't lend you any money, you're going to not buy that deal. So that's that. Number six we've covered. Let's go to the next page. I target certain types of properties. We talked about which house and where here a second ago, but I look for high equity properties. If somebody has high equity, and sometimes they just bought it and paid all cash for it, and they just bought it yesterday. And I bought a number of houses from people that bought them and then changed their mind, or the world changed, or their personal position changed, and they decided they didn't want this property. And the world is funny, but people make decisions with their money that are emotional decisions more often than I think very well thought out financial decisions. So sometimes people impulse buy houses, as strange as that may sound, but I know people impulse buy cars all the time. So, and a lot of other things. So long story short, I'm looking for high equity properties for two reasons. Number one, most of the time, if somebody has a high equity property, they've owned it for a while. And if some of the best deals I've made have been with people who have owned houses 20 or 30 or 40 years, because they remember that they paid a lot less for them 20 years ago than they're worth today, and they're easier to negotiate with. I am that person. When people buy property from me, and I sell properties occasionally, I remember what I paid. We sold a house here recently that we paid $50,000 for, and we just sold it for $279,000. Well, when you paid 50 and you're selling it for 279, somebody offers you 275, you say, hey, that's close enough, right? You get pretty easy to negotiate with when you have that kind of profit. If you paid 275 for it last week and now you're trying to sell it for 279, you probably are going to be harder to deal with. So I look for people that have profits in their property, that have high equity. And the other reason that high equity is a benefit to me is because it gives me the opportunity to offer them a down payment and ask them to carry back some of the payments, either with a lease option or just owner financing. So there's two different reasons that I'm looking for high equity property. And it goes along with the long-term ownership. The longer somebody's owned something, the more likely they are to have a profit and make me a pretty good deal. Existing unhappy lenders. In the last couple of years, lenders have been pretty happy. They've been making a lot of loans. People have been making their payments, but not all lenders are happy. Some of them are not happy because of if they have a loan, for example, on an empty commercial building, and I don't know about your town, but my town is loaded with empty commercial buildings. I mean, our big malls are half empty or 2/3 empty, some of them. So the people that have those loans are not very happy. And when we have business cycles and the single family house business gets soft and there's more foreclosures and there's more short sales, you find more and more unhappy lenders. Well, when you find an unhappy lender, there's an opportunity to make a significant profit without hurting anybody. The lenders are happy to get rid of those bad loans, and they're happy to discount them a remarkable amount. I'm not talking about 5 or 10%. I'm talking about 50 or 75% sometimes. So when you can get that kind of discount from a professional lender on the other side, they're happy to take it. You're not hurting anybody. It's just a business opportunity that appears during certain times of the cycle. Now, in order to take advantage of that, you have to have the ability to write them a check. And so today's a good day to start looking for people who have a little bit of money. If all your friends are poor, you need a couple of new friends, right? You need some friends that can write a check, and not just for $5,000 or $10,000, but for $50,000 or $100,000. And because the opportunities that will come along here during the next business cycle will be such that if you have access to some cash, doesn't have to be your cash. I took a seminar years ago, and the most important thing I learned in that seminar was it doesn't have to be your money. If you just have access to money or can control some money, it doesn't have to be yours. So if you have access to maybe somebody else's retirement account, or access to some friends who want to invest, or family members who need to invest, that money is not your money, but you can benefit from that by helping them make a profit and you taking part of the profits. Unhappy partnerships kind of goes down the same line as the unhappy lenders. Some unhappy partnerships are family partnerships, when husbands and wives split up, or they could be heirs that have inherited something and they want to split something up. Most of the ones I've been involved with have been business partnerships where 2 or more people have owned the property and somebody wants out for some reason. Well, the first one who wants out of a partnership, the rule of partnerships is the first one who wants out is probably going to sell out cheap. The last partner in is probably going to be the one who makes most of the money. So if you can control an unhappy partnership, let's say three people own a house and one of them needs their money back or one of them wants their money back. They're not happy with the way things are going. And you can buy out that partner. And if you think about how that would actually work, let's say there's, you have Tom, Dick, and Harry own this house, and you buy Harry out. Now you've got Tom and Dick as partners. You have to be in position to outlast Tom and Dick, or at least put up with them, right? Because they may be the reason that Harry wasn't happy. But if you can do that, if you can take control of the partnership or be very patient. I bought some stock one time in a bank here in town from a guy who was disgruntled and sold me his stock that he'd owned for years and years and years for a lot less than what he paid for it. And I knew that it was going to take a long time for that bank to sell, but I was patient. And eventually that bank sold and we made a nice profit on that. Well, the same thing's true with real estate. If you own a partial interest in a piece of real estate, I don't care if it's 1%, 10%, half, if you can hold on long enough and the property, is sold for a profit, or just sold and you bought your half for your parcel for a discount, then you're going to be in position to make a nice profit. And what happens in most of these cases is if you buy out one partner, you'll end up buying out the other partners eventually. So if you're in a position to do that, and again, it goes back to the basics though, it should be a property that you want to own, should be a property in a good location, well built, good neighborhood, all that. Don't bend the rule just because it's an unhappy partnership. But if you get in the right place at the right time, there'll be a lot of opportunities. So we're going to talk about these kind of opportunities in the class, things that happen during cycles, and we'll talk about opportunities that are available today and opportunities that we think will be available probably next year. The last bullet point on this page is high land to improvement ratio. If you think about houses just for a second, if you buy a brand new house in a new subdivision, you're probably buying an expensive house on a not so expensive lot. The ratio of the value of the improvements is going to be high compared to the value of the land. So, the rule of thumb in the building business is to build a house that's worth about 4 times the value of the lot. So let's just say it's a $50,000 lot. They'd probably be building about a $200,000 house on that. So you'd have a $250,000 package, $50,000 of it would be the lot, and $200,000 would be the improvements. I believe, and I'm sure this is true, that what really goes up in the real estate business, what goes up in value is not the house so much as the land underneath it. Not the house, but the land underneath it. Now, some houses are special houses, they're architecturally special, and they do increase in value. Most of them are high maintenance though, and you probably don't want to own those houses. But the typical house I own and that I've owned for a while started off on a lot that might have been worth $10 or $15 or $20,000, and now that lot's worth $150 or $200,000. Not because the house went up, but because the lot went up. So I have a profit in that property because the land values increase. Now, part of this is just due to inflation. The dollar buys less today than it did a few years back, and I think it's going to buy a lot more today than it will in a couple more years. I think we're going to have more inflation. So by owning something that has a good inflation hedge, like a piece of land, you come out ahead. Now, you just don't want to buy land, because if you buy a piece of land, and I've done this by mistake, I've owned several large parcels of land, but a property that has no income still has expenses. You still have taxes and insurance, and if you have debt, you have mortgage payments to make. So you don't want to go out and buy a piece of land, but you do want to buy a house on a good piece of land. And I stress that in my courses. The lot underneath the house is probably just as important as the house itself. So if it's a really well-built house, nice design, but it's on a terrible lot, that you shouldn't buy that. But if it's a really good lot, I'll put up with a house that's not perfect on a really good lot. But here's, if you work a little bit, you can find both. You know, you can find the right house on the right lot, and when you do that, you've hit a home run. So look for high land to improvement values. Some of the last houses I bought, just to give you real numbers, I bought two houses here in the last couple of years for about $300,000 a piece. The lots themselves were worth more than $300,000. So I'm buying a house and a lot combination for less than just the lot value. So I'm getting a house for free. And it's still a real house. These houses were remodeled, they rent well, so I get income. It's kind of the best of both worlds. I'm getting the income that the house produces, but I'm not paying anything for the house. So, and different thought. Larissa, let's turn the page.
Okay. And while I'm doing that, I also did have a request that you touch a little more on the business cycle, if you could.
Okay. You know, just talk about business cycles. A lot of people predict the next business cycle. Nobody knows what's going to happen. I got this feeling, right? Here's the things that gives me feelings. I look at builders in my town making extraordinary profits, okay, really high profits. And I kid about this. I say, you know, when builders start buying Cadillac pickup trucks and Lincoln Continental pickup trucks, builders are making too much money. And I have seen both Cadillac and Lincoln Continental pickup trucks recently in my town. And you know, you go to these building sites and you look around, trying to find an old truck. Most everybody working on these sites are buying a brand new $80,000 truck, or if it's a Cadillac or a Lincoln, I'm sure they're 100 grand trucks. It's kind of interesting. The other thing I look at in the house business is that when I find tenants moving out and buying houses, and I had this happen last month, I had one of my tenants move out and buy a house. When tenants can start qualifying for loans, that tells me something about the lending business. And one thing that causes the cycles in real estate is the lenders get stupid. They start making loans to people who can just barely afford them because they're trying to get money out the door. Well, they're starting to do that now, I think. They're starting to make loans to people who are, you know, I won't say they're marginal lenders, but they're not as strong as they would ask them to be a couple years ago. So the lending, the lenders or I think sending us signs that maybe they're getting too aggressive. And if they're getting too aggressive and the builders are getting too aggressive and the tenants are moving out, that's just a sign to be cautious. And I'm not saying doom is coming, but you know, the stock market's a little jumpy. Interest rates are as low as they ever have been. People are a little nervous about what's going to happen during the election. There's a lot of things coming together here that might make the perfect storm, that might make next year pretty darn interesting. So I'm looking forward to it. I like interesting. It's fun. This page talks about structuring your deal to distribute cash flow. We got a little box here that shows appreciation, cash flow, debt pay down, and tax benefits. Those are kind of the four major benefits in owning real estate. If you want the cash flow, you might give up the rest of these. And if, for example, if I want all the cash flow out of a house, what I would do is put together a deal where I would rent the house from an investor. Give you some real numbers. We had a house that we bought for about 300,000 round figures. The investor was coming out of a 1031 exchange where they had some land, so they didn't have any income off of their land. And I was able to net lease that property from them for about 4% of the $300,000 or $1,000 a month. And I was able to rent it for $2,000 a month. Well, I got to keep about $1,000 a month less my expenses, and they were happy with a 4% return on their money. So you can structure deals where you get all the cash flow today if you need it or you'll want it, and the person who's not paying taxes probably is the one who wants the cash flow. If somebody, the person on the other side, you know, the high income investor that's already paying a lot of taxes, probably doesn't want more cash flow. They probably want the appreciation. They might want the tax benefits if they can qualify for them. And the debt pay down, you know, is often a nominal amount, but that's part of it. So you can structure deals to distribute cash flow to the party who needs it most. And if you're, you know, it's just you and you have a pension plan, that when the deals we make in our pension plans, are the ones that have really high cash flow, so they don't have to pay any taxes on them until we take the money out, or if ever. Okay, next page, please, Larissa. Larissa.
Sorry, John. I had myself on mute. So I had a few more questions pop up while I'm
Okay.
switching the slides here. And one of them was, do you pay for insurance on your houses, or do you avoid that to increase your profit?
No, I pay insurance. You know, it's foolish not to carry liability insurance because that's prepaid legal fees and it's cheap. If you ever get sued by somebody, and I've been very fortunate, I've never had a tenant or anybody that did work for me sue me, but yeah, I've always carried liability insurance because if that does happen, you know, somebody falls off a roof or it's just an accident and somebody's injured, and you know, if you look at hospital bills today, you know, if your insurance didn't cover it, it could be a big problem. So I would carry insurance to protect me from that type of event. As far as casualty insurance, you know, which is fire insurance, flood insurance, wind insurance, you have to use some common sense and decide, you know, whether you can afford to take the risk. I don't carry wind insurance on any of my properties. If all the roofs on all the houses I own blow off tomorrow morning, I've got enough cash in the bank to put them all back on. And I can call my roofer and I can say, I will pay you cash if you go out, put a bunch of roofs on these houses tomorrow, start right now, and I'll get a little bit better service than I will from somebody who has to go to their insurance company and wait for, you know, the check. And I think some insurance companies are pretty good and probably pay pretty fast, but if I can do it tomorrow, I'll probably get better service. Now the chances, you know, I've been in this town all my life. I have been in Florida all my life. I've been through hurricanes all my life. So the chances of all the roofs blowing off all my houses in one day are pretty darn slim. I'd say maybe 1 out of 100 or 1 out of 200. I mean, you know, really, really small. So I am brave enough to self-insure for that. Now, fire insurance is pretty cheap. I've had 3 or 4 fires in my career. None of them have been significant. You know, most of the time people leave something on the stove in the kitchen, or one person left the uh, heating pad on top of a sheet and it caught on fire, you know, stuff like that. But we never had a whole house burned down. But when houses burn, you know, when they catch on fire, the damage is significant. So, you know, the fire insurance is deductible. And if you're paying a couple $100 a year for fire insurance, I think that's a pretty good bet. We don't carry flood insurance on anything. And I own a number of properties on the water. But again, the properties we buy on the water, we buy for less than a land value, less than a land value. So if the house washes away, you know, I still made a good deal because I bought it for less than land value. But again, my experiences in this town, I've lived on the water most of my life. I live on the water today. We don't carry flood insurance. We have never had a house flood in Sarasota in, you know, the last 65 years. So don't think it's going to happen, but it could. But again, the odds are in my favor, I think. So I hope that answers your question. We can go into more detail, but that's probably enough for this short conversation today.
What is your thoughts on the accessory dwelling units? We had a question pop up mentioning that they have 2 houses on one lot and they're considering adding an ADU above a garage. What is your thought on that, and whether or not it should be utilized, you know, to rent space to another tenant or possibly just a bonus space to existing tenants?
Well, you know, that's kind of a personal thing. I don't really have much of an opinion on that. The more cash flow you can get, the better off you are. But you have to do the math. You know, if you're going to spend $50,000 to build a unit, you've got to say what kind of return do I want on that $50,000. And I would say don't violate any building and zoning laws, because your neighbors will turn you in, and sometimes they make you take it down or you know, make a major change to your plan. So be careful with that kind of thing. I don't like to build new structures typically. And the reason is you generally pay retail for the materials and the labor. You know, if I hire somebody to go out and build something, they're going to go down to Home Depot and buy the lumber. That's going to be retail, and they're going to charge me so much an hour for their time. That's going to be retail. So I don't get a discount when I build something. If I can find somebody who's built something else, then I get a discount. You know, if I find somebody who's anxious to sell and they just finished building a brand new house and they're anxious to sell it, I'll probably be able to buy it for less than what they've got in it. We had one guy came to me one time, and then he sat in the office. He said, here's the bills. Here's all the money I spent building this brand new house. I said, yeah, that's nice. He said, I'll sell it to you for exactly what I've got in it. I said, I have no interest in buying it for exactly what you have in it. He said, what would you pay me? And my offer was probably 2/3 of what he had in it. and he just couldn't stand that. But here the long story, or the next piece of that story is he came back and sold me that house for that discounted price about 2 years later because he couldn't sell it to anybody else. It made no difference how much he spent on it, but it just shows you that you can buy things at a discount, and you don't get that discount typically, especially in a market where people don't need work, and prices of lumber have doubled here in the last 6 months. It's not a really good time to build something today, I don't think. Maybe wait a year, you might be able to buy things cheaper a year from now.
Great, thanks, John.
Okay, we skipped a page. You need to go back up a page now.
Okay. There we go. Sorry about that.
That's okay. We didn't rehearse this. This is a real-time deal.
It
So
sure is.
So just a couple of the strategies you can use to distribute cash flow. One is partial interest, of course, and you can split things up a lot of different ways. But one person could own the land, one person could own the building, one person. The first property I bought was a duplex, and I bought it with a buddy of mine, and I said, you own the upstairs and I own the downstairs, but the roof is yours. He said, no, that's not fair. So we had to split the roof up. But you can split properties up a lot of different ways. It doesn't have to be 50-50. It can be by time. It can be a lot of different ways. Options is a neat way to let somebody else have use of a property. If somebody comes to me and says, John, I need $20,000 for a down payment on a house, will you loan me the $20,000? If I loan them $20,000 and that's their down payment, they wouldn't have any money in that house at all, and that'd be a fairly high risk deal. And the chances of me having them be able to make the payments to me and the payments to the underlying lender puts them under a lot of pressure. So, but if I can make a deal with them to say, look, instead of lending you the money, how about I control half the profits in this house for the next 20 years? So if it does go up, I get half the profits if it goes up, and I'll give you the $20,000, and I'll bet that the house is going to go up. But if it goes up, I get half the profits over today's price, and that would be an option situation. Another way to structure is long-term leases, and I mentioned that a second ago. When I lease something to another investor here in town for the long term, they get some cash flow benefits. The major benefit I get is no management, and I get all the profit or half the profit, depends on the deal. So we can structure things different ways to give different parties the cash flow they need. And sometimes it's just for a short period of time. Sometimes people just need cash flow for the next 5 years, or sometimes they don't need it for the next 5 years. They need it from 5 years on. So we can structure things a lot of different ways, which is a lot of fun. It just makes you think about things. Okay, let's go to the next page now.
Okay, great. And I have a question for somebody asking, what if you're just starting out? You mentioned sort of what you insure and what you make sure to have in reserve in order to cover anything unforeseen, but what would you recommend for somebody starting out with, say, their first, second, and third house? Is there some percentage that they should keep in reserve just in case?
Well, first of all, if you're starting out, please read my book. It's going to save you a whole bunch of money. I mean, I only make $2 when you buy my book, so it's not going to make me a whole bunch of money. But I guarantee you, if you read that book, it'll save you tens of thousands of dollars. It'll keep you from buying the wrong property. It'll teach you how to manage a little bit so you don't put the wrong tenant in there. And all those things are much more important. If you know, the more you know, the less you have to have in reserve. I mean, the less you know, the more you need in reserve. If you don't know how to manage properties, your first tenant could be a bad tenant. It may cost you 6 months rent to get rid of those people and fix the house back up. So that would be a lot of reserves. But if you'll study some to start with, and you learn how to manage what kind of tenant you want, you buy the right house, you finance it right so you don't have negative cash flow, then you need a lot less in reserves. What I've always said to somebody, because when I started, I had no money, and so I had no reserves. We had the first apartment building I bought a 9-unit building early in my career, and I needed to collect the rent from each of those 9 tenants in order to make my payments. Okay, if I missed one of them, 1 out of 9, I wouldn't have enough money to make the payment, and I would lose the building. And I go over and knock on the doors, and I thought it'd be easy. I knock on one door, and I catch somebody home. I knock on the other 8 doors, and nobody'd be home. You have to sneak up on them one at a time. But when I got all 9 rents in the bank, then I could make the payment. Well, that was a lot of work to own that building. And I learned a lesson. And the lesson was, that's not the kind of building I wanted to own. I didn't want to rent to people who I had to chase and sneak up on to collect the rent. I wanted to rent to somebody who really valued where they lived and would pay the rent because they wanted to stay there. And that's how I switched to the house business early on. But so I'm not giving you a direct answer because I don't want to say you should have like 4 months rent in the bank. That would be plenty if you know what you're doing. But if you don't know what you're doing, that you may go through that 4 months rent pretty fast. But obviously you should have some reserves or the ability to borrow. If you don't have a bunch of cash in the bank, that's okay. I operated without any cash in the bank for a long time. Every time I get some cash in the bank, I go out and buy some more property. But I had the ability to get some money because I knew folks who I own property with typically who would lend me money if I needed it. So you can either do it with cash in the bank or the ability to borrow. Balance that out. Okay, the next page here, developing and maintaining $1 million relationships. The most important thing probably in my career has been the people I've been in business with and folks I've owned property with. I've learned from them. I've learned how to manage. I've learned a lot about borrowing. I've learned who to borrow from. So having that experience and we share those experiences. Peter and I both have had those types of experiences. And when we teach, we share those experiences with you so you can kind of get the feel, kind of put yourself in our place and say, okay, that's how they did it. That's how they found the investor. That's the kind of deal they made the investor so the investor was happy. It doesn't have to be your money. If somebody else has money and you can invest it for them and you do all the work, that's what most people are looking for. People that have a bunch of money in the bank or they get lazy at some point, but they're not happy about just earning 1% or 2% in a CD or some kind of money market account. That they're looking for a much better return than that. And by owning real estate, the returns are significantly higher than what they get in the bank. So if you're going to invest with others, a couple points here. You want to select investments and investors that have long-term potential. I'm not a flipper. And I don't encourage people to flip. I mean, if you want to do it for fun, go for it. But it's pretty exciting. I had a lady called me who heard me speak on place, and she called me up here a couple of weeks ago, and she said, I just flipped my first house. I said, how'd it go? She said, I only lost $10,000, and she was real happy with that. Well, that's not the result you're looking for. The reason I don't flip houses is, number one, it creates short-term, small income streams, and you have to work pretty hard for them. You have to go out and work pretty hard to make $20,000 or $30,000 when you flip a house, and it may take you 6 months or a year. Who knows? I'm not happy with that small of a profit. I like to hold properties until they double in value. So if I buy a house today that's worth $300,000, I will hold it until I make a $300,000 profit. Now that may take me a few years, but the $300,000 is worth waiting for. And when I make that profit, it's taxed at a capital gains rate, not an ordinary income rate. If I make a $300,000 profit and have to pay ordinary income taxes on it, about half of it's going to disappear, and that's a lot. So people don't think about that. And of course, if you're not good at flipping, you don't make much money, you don't pay much in taxes. But if you get good at it, a lot of your money disappears. Sharing profits rather than taking commissions, the second bullet point here. I had a broker's license for years. I had salesmen for years. I was in the commission business early in my career, but I learned early on that the profits made in the real estate business are significantly higher than commissions. And plus, you can, as I just said, you can defer tax on those profits. If I own a property for 5 or 10 years, I'm not paying tax on that profit until I go to sell it. So not taking commissions today, if you're just starting. People ask me all the time, should I get a real estate license? If you think you have the aptitude to sell things, if you're a good salesperson, you don't mind working hard to do that, working nights and weekends. I mean, it's a nights and weekend job. Sure, you get a license, you learn a lot. I used to teach a class on how to get the license, so I really understand the business. But sharing profits is much more lucrative in the long run than taking commissions. Limiting your risk and that of any investor, it's really important that if you invest with somebody else, that you take care of their money. And even when we lose money, I always stand behind. If my investor, I had an investor put up $260,000 right before the last big downturn, and the property we bought dropped in value in half. But I didn't give him half his money back. I gave him all his money back, and I took the loss because somebody who I invested with for years, who's made money with me and for me for years, expects me not to lose their money. So it's not a legal obligation. And you might even say it's not even a moral obligation. It's just good business that if you invest other people's money, that you have to protect them. So if you're not in a position to do that, don't take their money yet. And developing the skills necessary to acquire and manage. If you're going to manage other people's money, of course, you need to be a really good manager yourself, and you need to be able to buy things that are profitable. Not just retail prices. Ownership that provides protection and lowers your profile. Whoops, back up one. Back up one. Then, okay, there we go.
Okay, there we go.
My button, I don't think it's working. Maybe it is. Okay, that's the one we want right there. So, yes, we're about out of time, but a couple of quick points here. What you own is important. The properties we own are low profile properties for many, many reasons. I mean, people are not driving around looking to sue somebody who owns a little rental house, and the tenants who occupy that house like the house. They like me. They like their landlord. They like living there. They like the rent. They like everything about it. They're very unlikely to sue because they like it, and we've never had a suit because of that. We always use trust. We don't use partnerships, and we've used trust for years, going back to the 70s, to buy and own property with other people. And it makes a lot of sense. So if you've never been exposed to the idea of a trust, owning property in a trust, learn about it. Put that on your to-do list. And to diversify, you want to make sure that first of all, you diversify ownership. If you did have a whole bunch of money, you wouldn't want to have it all in one bank account, would you? You'd want to spread it around to several banks in case that one bank went broke. Well, if you have a lot of real estate, you wouldn't want to have it all owned in the same entity or by the same person, because then if that one person, let's just say Joe Smith owns 10 free and clear houses, well, he would be a target. Joe Smith now, if somebody would sue Joe, they could probably get access to all 10 free and clear houses. So you wouldn't want to do that. You want to have different people own those houses, or you want to have some debt on those houses. So diversification is a smart thing to do. Next page. We're about out of time, but we'll see if we can wrap this up.
Okay, there we go. Go ahead.
Okay, so retirement strategies. Whoops, maybe the backup one.
Okay, let's see.
There we go. Retirement strategies. Oh no, we did that one. We're okay. I won't talk long about retirement, but the reason most people invest in real estate, I think, is to have retirement income, and it's kind of, this chart shows, this very expensive chart we drew shows that your income increases, the cash flow increases on property dramatically over time. So you buy a house today that just breaks even. You just struggle to make the payments. You're not making a nickel net cash flow, but you hold on to it for 10 or 15 or 20 years. And one day you wake up and you're collecting twice as much rent, or maybe 3 times as much rent. And we've got houses that we collect 5 times as much rent on than we did when we bought them. So the cash flow does go up. And of course, the other thing that makes cash flow go up is paying your debt off. And don't have time to talk much about paying debt off right now, but if you could end up with some free and clear houses, and in my book, that's what I talk about, is a goal of buying one house a year with the goal of owning a number of free and clear houses. And I teach people in the class, most people, if they ended up with 10 free and clear houses that netted them about $1,000 a month each, that'd be $10,000 a month in income. That'd be enough. And in today's dollars, that'd be enough for most people. Now, if you want to go out and fly a jet or charter a jet, you need more money. But if you're a pilot like me and you can fly a single engine airplane and you have partners like I do, you can afford to do that within free and clear houses. So it doesn't have to be an extraordinary goal, but your cash flow will increase over time if you buy the right type of property. Okay, next slide, please, Larissa. So once you have enough, you can trade growth for cash flow. Once you have enough net worth, you don't need to double your net worth one more time. You can convert some of that growth to cash flow. Don't risk your capital. As you get free and clear properties, set them aside. Don't put them at risk. Beware of new friends who want to manage your money. It's amazing, especially if you play golf like I do, how many people you meet on a golf course that they're in the money management business and they want to help you with your money. I have one guy that wanted me to sell all my houses and give him the money. I said, I don't think that's a good plan. And then when you're a target, you attract predators. Being smart, especially as you get a couple years on you, being smart. The advice I give people is never put more than 10% of your assets in any one deal, no matter how good they are. If Warren Buffett calls you up or Bill Gates calls you up, don't give them any more than 10%. It could go wrong. Okay, next page. So this kind of tells you where we're going to be. We're going to be at the Holiday Inn West Shore. And again, if you can come to the class, please don't walk in. I don't think this is a walk-in type of environment. We want people pre-registered. Please don't come if you're sick. We're going to ask people to wear a mask. We're going to separate people. This room is going to be set up where people are not closer than 6 feet from each other. We've asked them to increase the filters to make them safer, but we can't guarantee it's going to be 100% safe. But Peter and I think is an acceptable risk, or we wouldn't teach. We're going to stay way away from people. We're not going to be able to hug anybody. Won't be any photo ops in this class, but we certainly will be available to answer questions. And we always do that. We're going to teach Saturday and Sunday, and Saturday night we'll hang around after class and we'll do a question and answer session. So if you come and you have questions for Peter and I, we'll be happy to answer them on Saturday night. $549 single registration, $950 for any 2 registering together. So those are the numbers. And if you have any questions, you can email me. My email address is schaubrealestate@gmail.com. SCHAUB realestate@gmail.com. I'll be happy to answer your questions. Larissa, thank you. I'm happy to hang around here for a few more minutes if anybody else has a question today.
Okay, great. And we did have one question pop up asking if people would also be able to attend the seminar online. So I don't think you're offering an online sort of option for this one, but I thought I would ask.
We are not, and I don't think that with this short notice we can put that together. I mean, we have had 2 or 3 people that wanted us to do that, but I don't think that's going to happen this time. We may well teach this class again next year. If the world changes, the world will change. We'll probably teach a different class that'll have some of these components next year. But if you can come this year, I think you will learn things here that'll help you both survive and prosper here for the next couple, 3 years.
Okay, great. And I just want to remind everybody, johnschaub.com to register for the class, and he gave his email information as well. And I think we can also share these slides if that's okay with John. So if you guys would like the slides, just go ahead and email me and I'll make sure to get them out. My email address is lgreen, GREENE, @advantaira.com. So I think with that, I don't see any other questions pop up. Again, just reach out to me. I'll make sure to share the slides. And thank you so much, John, for joining us.
It's been my pleasure, Larissa. Look forward to seeing you soon.
Thank you. Take care.
Bye-bye.
Bye-bye.